Good morning, everybody, and welcome to our final panel for the portfolio managers. Thank you for being here, and welcome to the 29th Annual Barron Conference. My name's Frank Maiorano, and I head up the family office, registered investment advisor, and bank trust businesses at Barron Capital. And today our panel is on large cap, high growth, and global investing. So I'm going to start off, we're going to do this a little bit different than some of the other panels. We're actually going to have a little bit of a lightning round and go direct to the audience for questions, because we know these are some fairly popular portfolio managers. And I do have some questions teed up, but we're going to go directly to the audience. So all you need to do is just raise your hands. A mic runner will come over to you and ask to the questions. So Alex, if I can start with you, just introduce yourself, your tenure at Barron, and which funds that you manage.
Sure. I'm Alex Umansky. I've been with Barron for 11 years. I manage the large cap strategy, the global strategy, and the post-high growth strategy.
Ashim, Mehra. I've been with Barron for 11 years as well. I co-manage the Barron Technology Fund, and I run a fund for accredited investors called the Barron Innovation Fund.
Good morning. My name is Mike Lippert. Almost got these guys doubled. I've been here, hard to believe, 21 years now. I run the Barron Opportunity Fund, the High Growth Strategy. I co-manage with Ashim the Barron Technology Fund. And we look forward to your questions.
Perfect. So let's go right to questions. If you could raise your hands and the mic runners go over here. Gentleman right here in the front.
Before you do, I just want to make sure you guys understand this is what's known the PTSD panel. So please be gentle, right? Be kind. Go ahead.
Well, good morning. Hopefully this is a softball then. Alex, you've spoken a lot in your quarterly letters about how you define risk as the probability of permanent loss of capital. I was hoping you could just expand a little bit on how you define it, but how you measure it, and maybe give an example, if there are any, of when a position in the portfolio has lost, has had a permanent loss of capital.
Did I mention PTSD? So we tend to measure our risk and our returns in what's called monthly rolling returns over longer periods of time, ideally over full market cycles. And 3 to 5 years is really the preferred way for us to look at it, right? So we look at quarterly returns, monthly returns, annual returns, 3-year, 5-year, et cetera, et cetera. So if you look on those metrics, right, we have done exceptionally well. So we typically outperform, I don't know, roughly 60% of the time on a monthly basis. If you extend the time horizon to quarterly, it'll be 2/3 of the time. You look at it on an annual basis, it rises to about 80%. On a 3-year basis, it's about 90%. On a 5-year basis, we have outperformed 100% of the time, right? That's benchmarks, that's global, it's MSCI ACWI growth, it's peers. Now, volatility obviously is a risk, and the way it turns into permanent loss of capital is when people lose patience and they lose, they lose faith and they sell. And just like many other funds, we have obviously been hit with redemptions. And when you have to raise capital to meet redemptions, you sell in stocks, right? And when you do that, you turn them into permanent losses of capital. So we are fairly confident that most of stock price declines in our portfolios are not permanent losses of capital. There are multiple contractions, there are challenges, and that over time, they will recover, right? But if you have to meet redemptions, if you have to fund other purchases, then obviously in some cases you will get permanent losses of capital.
Perfect. Next question. Right here.
I think it's fair to say that our investors are very fearful right now. So when that happens, stocks can be very attractively priced. So how do the Barron funds raise or find the capital to invest in stocks at these attractive prices? And then very quickly, I'd like to ask Alex when he will be on Wealth Track again.
So the question is, with valuations where they are, how are we finding stocks? Mike, you want to start with that one?
Did you say find capital to do this? Yeah, yeah. So what I've done with my fund this year, and I've described it in my quarterly letters, and this was similar to what happened, for example, in 08 and 09, I've concentrated my portfolio. And so to start the year, we were probably roughly 60 names, and now we are a little bit over 40 names. Like individual companies, we have a few more securities. I joke about it with the saying, you know, you will kill the weaker member of your herds to feed the stronger member of your herd. The more you concentrate, of course, you like everything in your herd, but you like certain things more. So that's what we're doing. I mean, you can call it improve the quality of the portfolio, but I'm doing it in a way that is very consistent with Barron. Like, what companies do I think are the best in terms of their long-term growth opportunity? Most important, their competitive advantages. Now where the valuation is, what kind of return will it give us? What's the risk of further downside? And we definitely, you know, we look at downside and we know what's happened this year. We absolutely lean into what we think the long-term opportunity is in a company. And so that's what I've done with my portfolio. And so basically it's been, you know, concentrating the portfolio to raise capital, put in what we believe are the very best companies. It sounds like an oxymoron in a market like this. You try to take advantage of this atmosphere to make the portfolio as good as it can be. And that's what we've been very focused on doing in a pragmatic, step-by-step way. You talk about fear, and there's a lot of fear right now. There's a lot of emotions in the market. I could see it. What we're trying to do internally is to not, you know, let those emotions control us, but to stick to our research, our processes, our long-term philosophy, and try to make the very best decisions we can.
Perfect. Thank you.
No, I think that's good.
Gentlemen,
what about
right
Wealth Track?
on my left.
When are you going on Wealth Track?
Whenever they call me.
Thank you for taking questions. You guys were really early in looking at innovation and looking out in the future, and obviously your success led to a few competitors out there. You know, ARC funds is one, and even NASDAQ is arguing that their QQQs, by all their millions of commercials, are really investing in innovation. So the space that you had kind of carved out really to your own has been crowded, and with the basic premise of if you buy a bunch of companies for $50 billion, if they all turn out to be worth $1 trillion, does it really matter what you paid for, $100 billion or $50 billion? But how does valuation come in? I still get back to valuation, and great companies, too high a price, don't seem to be good investments. So ultimately, it's valuation. So how does that really play in? And when you're in a space that's doing so great and everyone's doing great at the same time, is it possible to really have that price discipline?
So the question is on valuation as it's related to innovation. And Ashim, you run kind of the innovation fund, so that might be a good one for you.
Yeah, I think it's an excellent question. And we all have innovation, a lot of it in our portfolios. And that's what drives the high growth. I think it's important to, first of all, I was looking at this quote that Bezos said a while ago, and it said that, you know, frugality drives innovation. And my point is we're in a part of the cycle where there's a lot of fear. Companies' growth rates are contracting. But at the same time, what you're going to see is consolidation to platforms. There's been too much capital, too much cheap capital. I think we all recognize that. What's happening now is that capital is pulling out. We have companies that offer 4 or 5 different point solutions as part of one platform. And then you have companies that are private that may be selling one of those. And you want to make sure that you're betting on, Mike talked about consolidating the portfolio. We're betting on the companies that are making platform bets, that are going to have multiple products. So then when they go to a customer, they say, hey, instead of buying these 4 different products separately, let me give you all that functionality in one product and at a better price. And those companies, and what we saw this in 01, we saw this 08, the teams that come together during difficult times and have excellent product come out much, much stronger. So we're spending our time, first of all, figuring out which of those companies are. Second, to your question of valuation. Valuation is the output of the first question, which is which of these really special companies that are going to have the competitive advantage. The second part of that is we have to discount the growth rates for next year. We know all these companies are slowing. But when you come out of this, and I don't know when, I don't know whether it's 3 months, 6 months, 9 months, at some point people are going to say, you know what, what's 24 going to look like? I know that sounds so far from now. But these are the companies that are going to come out growing at 30, 40%. And if inflation moderates, the market is, right now tech is a 4-letter word. It literally is, I mean, you can't say tech and we are not popular people in many places right now. And that will change. And it's so hard when you're at the, when you're in the construct and you're like, okay, things are bad. But back to your question. So we're looking at 24 and we're looking at 25. And we're like, what are the best companies going to be? Who has competitive advantage and who is going to grow the fastest and be able to generate cash flow? The market forgot about cash flow for several years. That discipline is back. These companies that are going to come out of it are going to come out of it stronger, more efficient, and generating more cash flow.
I just wanted to touch on one thing, because I think this is a very, very important question. Oftentimes when people think about valuation, they're thinking 1 year forward. We're not ignoring that. We're looking at that too. We're thinking about upside, downside. But when we look over the history of our firm and the history of our funds, it is honestly finding those companies, and I use this tagline, that can grow faster for longer. They're going to compound and grow faster and will ultimately produce an earning stream or free cash flow. So we have to understand their business model. That is most important, way more important than getting the multiple right. Everyone can ask us questions about multiples today. To touch on for a second, we're very aware of where interest rates are, inflation. We try to use long-term, in my funds, median multiples. Given what's going on today, we're not just using median multiples, we're using multiples at the low end of the range. We're also doing lots of different studies, downside scenario studies, to see still what is our upside. And yes, across our portfolios today, these type of companies, on our base case, we're seeing, no lying, over 20% upside. On downside cases, we're still seeing double-digit long-term returns. So that's what we're doing today.
Alex, you want to add something?
Yeah, I want to put my 5 cents in as well. First of all, valuations by definition are not precise. As much as people want to make a science out of it, it really is art, right? Multiples are approximations. But the second really important part, and I'm going to disagree with Ashim here a little bit, I don't think the market forgot about cash flows. We were operating in a zero interest rate environment, right? When you do valuations, cost of capital matters. When your cost of capital is zero, it is not difficult to pay high multiples on future cash flows, right? Because the cost of capital is negligible. And this is why everyone is so obsessed with Powell and what the terminal interest rate is going to look like and what the terminal cost of capital is going to be. Because as that number rises, multiples by definition have to compress, right? Your hurdle rate gets higher and higher and higher. So if we're going to be operating in a 5% interest rate environment, that's one thing. If it's 7%, it's a completely different thing, right? And so the other thing is everything is cyclical. As much as we all want to believe that we're investing in secular growth trends, right? At the end of the day, the cycle will impact everything, right? We're all cyclical. Our moods are cyclical. Our ability to make good decisions actually is cyclical. Everything is cyclical, right? And right now we're in a really tough part of the cycle. And when that happens, right, that's what happens to valuations.
Can I get that on this same vein? Technology has been beaten up. We have inflation. We have fears of recession. Can you just comment a little bit on valuations in technology and maybe even mention some names that have been beaten up that you are actually optimistic about?
I mean, we could probably cite many, many names. The market, particularly in environments like this, and Alex is right with cyclical, and the other question was right with the market being, very scared. Markets go through periods of greed and periods of fear. So right now the market is incredibly myopic. They can't look forward. And so we have this saying, I think Ashim used it once, extrapolate the last data point. So right now we're cyclical. Things are a little bit weak. Stocks are going down. The market has taken the last data point and saying that's where we're going without stepping back and saying the economy is cyclical, just like Alex said, it will get better again. What are the secular growth trends? What companies have just tough compares against a pandemic and therefore, projecting this growth rate makes no sense. And so that's what we're doing. I mean, I could cite one company that everybody knows. Ashim and I were just talking about it yesterday. For example, Google, which now could trade on GAAP earnings, so it's not like non-GAAP. And we did the calculation yesterday on just a 1-year forward number. We much more care about what the long term will be. It was trading 2 or 3 points below the S&P 500. And that makes no sense because Google has one business, search, which isn't going anywhere, more mature than it used to be, but effectively, a monopoly, a very high margin business. It's also participating in the cloud, and even though that's a little bit disappointing, what did they grow? 40% in the cloud, so that was a little bit disappointing. So that's just one example. I mean, my colleagues can give you others. I could list a bunch of others, but I'll stop there. And so we're again trying to find where what we believe the long-term opportunity is for a company. The companies with real competitive advantages, and where there's a complete dislocation in the market today between the current price and what we think that company ultimately will be. The one last thing I will say is, you can read it in my quarterly letter. I talked about our investment history in a company called ServiceNow, and I talked about it over a period of time. And over the period of time when I wrote this in the quarterly letter, it was something like 8 years, the stock had something like a 30% pullback 8 times or 9 times. Yet from the time that we invested to the point I wrote the letter, even after it had a pullback, it was an 8-bagger. So cycles go like this, stock cycles go like this, economic cycles go like this. As long-term investors at Barron, we're trying to go through, plot that return line through the middle of those ups and downs.
All right. Questions? Gentleman in the blue shirt over here. No.
Alex, could you please explain the journey with Rivian? And secondly, on a brighter note, your journey with Facebook, which during your February call, you should have spoken more about. That is what you ended up doing with Facebook last year.
So Alex, talk about your journey with Rivian and a little bit on Facebook as well.
So the journey with Rivian has been interesting. We met the company, I'd say, 3-4 years ago, Mike, what would you say? A couple of years before they went public. We recognized that they're a beneficiary of disruptive change. We really liked the management team. We ended up making a very small investment in a private round with the valuation of $8 billion pre, I think, $10 billion post. This was a small position. The purpose was to really get a seat at the table and understand what the goalposts are, what the milestones are, how they're executing, and try to get enough knowledge and enough conviction to make it a real position by the time the company goes public. Okay? We then participated in another private round a little bit later, where we made it a larger position. I believe it was around 20 billion market cap, right?
Yeah, it was in the 30s of a stock price for that.
Stock price, right. And then, of course, in October of last year, the company finally went public. Mike and I went out to visit the company a couple of weeks, maybe even more, about a month before that. We spent 2 days touring the plant, meeting with, I'd say, probably 24 of their top-level managers, watching how they build their batteries, how they build the chassis. I mean, very intense due diligence. We also had conversations with management during which we tried to convince them to value the company conservatively. So the bankers at the time were suggesting, I think, around $60, $70 billion valuation. We tried to convince them to be more conservative because this is a company that is capital intensive and that's going to need a lot of capital in the future. So we said, look, this is your first foray into the public market. Let's make sure you price it right? Don't be greedy. I think they listened, and they did that, of course. Back then, this was a different world, and the demand was really high, and they ended up being something like 40 or 50 times oversubscribed. So they had to raise, the bankers had to raise the IPO range multiple times, and it ended up coming, I think, 20% above the range at the price of 78, I want to say. Since we did get our conviction, and we have known the company for a few years, and we believed it was going to be an eventual winner, right? It was what we call a big idea, a company that can be materially larger in its end game. We ended up taking putting in a large order, and this is probably the first time in my 25-year career when our order was filled. Normally, when an IPO is 50, 60 times oversubscribed, a good allocation is to get 1% of the deal, right? That's when we feel like we're treated well. Maybe you get, I don't know, 5% of what you ask for, right? Or 1% of the, we got filled. So on one hand, you get a little bit worried. On the other hand, you recognize that management is trying to do right by selecting the right investors, right? By choosing people that want to be there for the journey, that are long-term, and going to be there for a long time. And when the stock started trading, it went from 78 to 178 over the next couple of weeks, right? 3 or 4 weeks. And then, of course, the world changed. There's a different regime, right? Interest rates started rising. We are in somewhat unprecedented world because we have never had interest rates rise as quickly as they have this time. Unprecedented, right? And in this world, a company that has no cash flows, a company whose cost of capital is rising, that may need to go to capital markets again, obviously gets quickly out of favor, right? So the stock goes from 178 down to whatever it is now, I think mid-30s, right? It bottomed in mid-20s. We still own the stock. We still have a lot of conviction in the end game. We still believe that they are an eventual winner. They have made a couple of mistakes along the way in terms of pricing and trying to respond in what is a very challenging, dynamic environment. We have ended up reducing the position size, and I think that's probably fair, for all of us. And that's the journey. We're still there. We're still optimistic. We still think it's going to be, a winner in a world that is going from internal combustion engine to autonomous electric mobility. And Rivian, of course, is a play on two sides because they have a consumer business and they also have a commercial business. And we think that they can do very well on both sides. I'm going to stop.
In the essence of time, there was also a little bit on the Facebook question for any of the panel.
Yeah, I'm not sure exactly what you meant in terms of Facebook because we've done different things. We've exited Facebook at the end of last year in global. We cut it in half and fifth, and we actually maintained a decent-sized position in the post-high growth strategy. So we've been all over the place with Facebook. We think it's obviously a more mature business. It's a business that is challenged by, all kinds of, bad actors, right? Hate speech, et cetera, et cetera. We think metaverse is very interesting. We think Mark Zuckerberg is a visionary leader, despite all the hate and some missteps that he's made. And we think the stock is dirt cheap, right? It is basically trading at a valuation that implies that they will never, ever grow again. So I don't know exactly where it is right now. Last I looked, it had a 9.5% free cash flow yield. At that price, you're pricing in perpetual decline in the company's cash flows. We don't think that's the case. Even if metaverse fails, and of course they're putting in tens of billions of dollars into Meta, at some point, if it fails, those investments will go away. If they go away, you get a material headwind to the stock. So, is it still a big idea? That's a different debate, I think, right? Given how penetrated they are and stuff.
Perfect. All right, thank you. Question. There's a gentleman right here in the middle. Let's see with wait for the mic to come over. Raise your hand. There you go. Thank you.
When you're dealing with some of these innovative companies, electric vehicle makers, sometimes you're dealing with things like, are there going to be enough raw materials, rare earth materials? Is the electrical grid going to be able to supply the amount of cars to justify that valuation? When you get to a place and you say, we don't have clarity if that's going to play out, we need society to catch up to where this company is going to go, where does that take you in your valuation process? Do you assume that the rare earth materials will be able to support it? Do you assume the power grid? And you don't have to limit it to electric vehicle makers, but it's something I wonder about, whether it be geopolitical risk with China, who exports a lot of these rare earths, things like that. When you get to that fork in the road and you say, the success of this company depends on a certain thing that is uncertain, where does that take you in your valuation process?
So it's kind of talking more broadly about electric vehicles and rare earth and the materials to make the car, geopolitical issues. Mike or Ashim, you want to take that?
I'm going to try to be quick, and this is a much deeper answer. First of all, if you do a whole bunch of research and you end up with uncertainty, you don't know the answer, that should absolutely impact your investment. So maybe you should own less of that particular company, or you should own none of that particular company. On the questions that you ask in particular, we've done a tremendous amount of research. You obviously know the tenor of our investments in Tesla, now Rivian, which Alex talked about. And so there's a lot of stuff that's in the news. We are not at all concerned about rare earth materials. I'd say the bigger issue with regard to lithium is not how much lithium there is in the earth, whether or not we built enough refining and processing capacity. And that just is a matter of capital. So we don't see, in particular to electric vehicles, anything that, that we consider to be an uncertainty or something that we can't research. I mean, for example, when you think about, China, and right now there's, the U.S. CHIPS Act, for example, which has some restrictions on intellectual property that went to China. And in the semiconductor investments we have done a tremendous amount of work to try to understand what that is, talking to all of our companies exactly what the impact is today, potentially what it could be, could the regulators go further? So we do all this homework. On that one also, we think that we've sized with some of the main companies that we've invested in, for example, NVIDIA, honestly, exactly what that risk is now. We can do some scenario analysis of what it could be worse. But the clear answer is if you run into a situation where there's uncertainty, you can't answer that, you should absolutely reflect that. In my own career, I have done so in different investments. I could highlight those if you want off stage, but absolutely we do. We don't just make assumptions. We do the research and we try to find the answers.
We have time for one quick final question. If we, gentleman right in the middle, if we could get a mic right dead center.
Yeah, but you were talking about the stock that went from 30 to, or from 78 to 178. When do you make a decision that, hey, this is a good opportunity to make some money? In 2 weeks, if you just watch and see NBC or something, you see that stuff, boom, boom, boom. At what point do you say, hey, I want to make some money on this thing?
So when a stock goes way up, when do you kind of make that choice to cash in your chips and make some money? Ashim?
I think we all do it slightly differently, but within the same framework. I think ultimately, for me, I have to look at the valuation that you're paying for what's embedded in the growth. And, there's a company that I sold that went from 60 to 200 in a 3-year period. Mike still held on to it. And the stock has done fine from where I sold it. But for me, at that point, the growth that was embedded in the future forecast was such that even in 3 years, I didn't see making the IRR that I held. Now, the stock's done fine, and just the fact that it's held in there, and since the time that I sold it 6 months ago, means it's massively outperformed. But I think you have another answer.
I'm not sure exactly what stock that, Ashim... Oh, yeah, okay. So that stock in particular is a company called Shockwave. I continue to own it. I have reduced it in my portfolio. I think that there's a lot of option value there, and I've seen what the company's done with innovation, and so I've decided to keep that stock. It is rare that I sell what I consider to be a great company. By great company, it is a long-term growth opportunity. Typically, it's a company that we have, call it first or second acts, what we also call multiple TAMs. They have more than just one product or service. Maybe they're on their way to becoming this, what's called a platform. So if I find companies like that, I'm quite reluctant to sell simply on valuation. I may take that stock down in my portfolio. However, in the, I guess it was, the 2021 period, there were certain stocks, a couple of software stocks that I have in mind, that got to valuations where I couldn't make money in 5 years. And I chose to sell those companies, put that money into others, and 2 of them I repurchased this year on a very, very significant pullback. I had them on a watch list. I knew what I thought the quality of those businesses were, and I did that. But that's mine. Alex may want to expand because he may do it differently than.
Since you addressed it to me, meaning 78, 178, 25, right? So for me, the decision to go or no go, fight or flight, is made during the due diligence process. When we were visiting the company, when we were spending 2 days, right, and digging into it, this is when you make a decision. Is this a big idea? Is this something that you want to own? I remember on the flight back, we had a pretty rigorous debate. It was Ishai, it was Mike, it was me, I think Guy was there as well, and we were kind of going back and forth. So what do we pay for this? What is it worth? Where is it going to be 3 years from now, right? What is the range of outcomes? What are the probabilities? What are the consequences? For me, that's when I make a decision. The price is what the price is, right? I want to focus on competitive advantage. I want to focus on the addressable market. I want to focus on the opportunity set. Is this competitive advantage durable, right? Is it disruptive? Is this one of the leading companies that I can bet on? And as long as that stays true, we're going to be invested. So that's the strategic part, right? How much? That's tactical, right? And that's a function of flows, it's a function of rates, it's a function of multiples, it's a function of everything else. But the fight or flight decision is made during the due diligence.
I just want to add one thing if I can, and this is not, we're all talking very, very fast, so we're not saying everything. So one of my roles at Barron Capital is what's called Head of Technology Research. So I work with all of our analysts. I want to be clear, we develop, and we do a lot of work to develop a thesis on a company, what we believe the long-term opportunity is, what we believe the competitive advantages are. But we don't just stop there. We do it again. We do it again. We do it again. I was just having a conversation with an analyst literally yesterday. A bunch of questions came up. We looked at them in June. We talked about what we found in June. We had picked up some new information, and I said, hey, it's now November. Let's just do it again. Let's just do it again. So we're always asking the question. So people think that buy and hold means you buy and you never look at a company. We never do that. We constantly do the research again and again and again. Ask the questions, ask them over and over again, because sometimes the world changes. And there's a lot of detail here. With regard to Rivian, I still own the company like Alex. Wow. There are things that have changed. The supply chain environment, energy prices, a whole bunch of things have changed. So we still believe in the long term, we still believe in the competitive advantage, but we've absolutely made some adjustments, for example, to our projections and when they will reach certain levels. So I want to be clear on that.
Perfect. So we're out of time. I want to thank our panelists. We have Alex manages the Barron Durable Advantage Fund, the Barron Global Opportunities Fund, or the Global Advantage Fund, and the Barron Fifth Avenue Fund, and we have the Technology Fund, and Mike manages the Barron Opportunity Fund. Thank you very much. I know Ron has a very special guest, so thank you for your trust, and we'll see you in the main room.